Hey everybody, welcome to Mortgage Today for Friday, February 16th, 2024, and oh, what a day it was. UMBS were down 33 basis points bright and early this morning. Ouch. The month-over-month core PPI came in at 0.5 on a 0.1 forecast. It was negative 0.1 previously. Year-over-year core PPI came in at 2.0 versus a 1.6 forecast. It was 1.8 previously. This is a huge miss for this report, even after considering the fact that it's more prone to misses than CPI. It's also less prone to be one of the big market movers, otherwise things would be drastically worse. Even so, they're not great. Healthcare was a big driver of the increase in services cost, and services inflation was driven primarily by wages. Housing starts rose 1.33 million in January, which was way below expectations. This is 14% below December and down 1% on a year-over-year basis. Building permits fell 1.5% month over month to 1.47 million, which is up 9% on a year-over-year basis. The mix of permits is changing pretty dramatically, with single-family houses up 36% year-over-year, while multifamily is down 27%. Remember, we have a record number of multifamily units under construction, and rental inflation is leveling out. Builder sentiment improved in January according to the NAHB, which is nice, but go build some more damn houses, come on. The percentage of all cash buyers of existing homes in 2023 averaged 28% of all sales, well above the 22% trailing average seen since the end of 2015. In fact, it's been above that trailing average since October of 2022. In the short term, it's nice to see that today's massively higher PPI reading didn't do more than it did to crush the bond market spirit. This isn't the craziest turn of events, given that we already had a bit of a spirit crushing after Tuesday's CPI, but that several Fed speakers said that they're not reading too much into 1 month worth of data that breaks from the recent deflationary trend. In the slightly bigger picture, however, there's an opportunity cost. Sure, things may not be unimaginably worse than they were last week, but where would we be if the inflation numbers came in below forecast? Very likely, it would have resulted in a much more constructive narrative heading into March, where a decent result in the non-farm payrolls and CPI in 3 weeks would pave the way for the Fed to give the first signal of a rate cut in subsequent meetings. As it stands, the data released in March is bond-friendly, then it can be taken with a grain of salt until April, waiting as opposed to less. So at the end of the day, MBS closed the day down 23 basis points at 100.22, which puts us right on this bright blue 200-day moving average, with all of our technicals kind of converging on each other, which could provide stability, but it doesn't promote getting up into this higher range that we need. Next week, we got a bunch of Fed speakers talking. So Bostic on Tuesday, as well as a couple of auctions, and then Fed minutes and a Bowman speech. Then we have jobs on Thursday. And then we get a whole bunch of Fed speakers on Thursday talking about all this stuff. So everybody's going to be trying to decipher from that. Also, check out something from our sponsor. So we got a brand new series from our sponsor at wellthatmakesense.com. These are the reading notes for a great book called The Fifth Agreement, which is an extension to the 4 agreements that you've probably heard of, which is probably one of the best self-improvement books per page or per word that I've ever read. The Fifth Agreement is a nice extension to that. So check it out on wellthatmakesense.com. And over the weekend, check out some of our common influences and sources, which includes our sponsor at wellthatmakesense.com.